What is long-term funds? Long-term finance can be defined as any financial instrument with maturity exceeding 1 year, such as bank, loans, bonds, leasing, and other forms of debt finance, and public and private equity instruments. What is short-term funds? Short-term funds is the money that has been borrowed for a short time, usually less than 5 years. Borrowers are often businessmen seeking to raise short-term funds to clinch deals. What is the difference between long-term fund and short-term fund? The primary difference between long-term and short-term financing is in the length of time the debt obligation remains outstanding. Short-term financing involves a loan term that is typically less than 1 year. Conversely, long-term financing is a debt obligation with a loan term that is greater than 1 year. What is overdraft agreement? Overdraft is a loan which is provided by the bank to the borrower and which allows the borrower to have a negative balance on his or her account, with the borrower obliging to repay the loan to the bank under the terms and conditions stipulated in the agreement.
Accounts receivable financing. Many banks and non-banking financial institutions provide invoice discounting facilities. The company takes the commercial bills to the bank, which makes the payment minus a small fee. Then, on the due date, the bank collects the money from the customer. This is another popular method of financing, especially among small traders businesses that offer large terms of credit can carry on their operations without having to wait for the customers to settle their bills.
Is a type of funding in which a company sells its outstanding invoices to a third party for a reduced amount of their value. Business may or may not remain responsible to ensure payment. It has to take action to make sure customers pay on time. Or else the company might owe the funding provider for unpaid invoices. But in all cases, the goal of accounts receivable financing for the business selling it to receive a cash.
Customer advances. There are many companies that insist on the customer making an advance payment before selling them goods or providing a service. This is especially true while dealing with large orders that take a long time to fulfill. This method also ensures that the company has some funds to channel into its operation for fulfilling those orders.
But they all have one thing in common: stiff interest rates and fees. The most popular type of a cash advance is borrowing on a line credit card. They typically carry a high interest rate as well as a rate is either or a percentage of advance amount. Merchant cash advances are loans received by companies or merchants from banks or alternative lenders. Typically, business with less use cash advances to finance their activities. A payday loan is issued by specially payday lenders. The lender determines the amount of the loan based on local state regulations and the size of applicant's paycheck. Considering the high rates and fees, cash advances should be considered a short-term solution for emergency situations. And you should only take out one if you retain you can prepay it.
Selling goods on installment or an installment sales is a financing arrangement in which the sellers allow the buyer to make payments over an extended period of time. In an installment sale, the buyer receives the goods at the beginning of the installment period and makes payments over an installment period. Revenue and expenses are recognized at the time of cash collection and not at the time of the sale. An installment sale allows the buyer to make payments over an extended period of time. Revenue recognition recognizes revenue and expense at the time of cash collection and not at the time of sale. It is used when ownership is not fully transferred at the point of sale. It is used when there is a degree of uncertainty in collection of cash. It requires the buyer to make regular payments. It is useful for taxpayers looking to defer capital gains to future years. These types of sales are common with real estate.
What is long-term financing? Long-term finance can be defined as any financial instrument with maturity exceeding 1 year, such as bank loans, bond, leasing, and other form of debt finance. And this could be in a public and private equity instruments. Long-term financing plays an important role in financing management for every firm. It is defined as the credit facility given to the firm for more than 5 years.
Long-term sources of finance are required for firms to manage their long-term liabilities, financing the fixed capital required for the instrument in fixed assets. It involves the financing decisions for the long period of time that also has more risk. That's why long-term sources of finance is also known as capital budgeting decisions.
Long-term financing in bank. Banks are the main source of finance for firms and households, and thus are essential to understand the debt maturity structures across economics by pooling saving and transforming short-term deposit into long-term loans. Banks takes on a liquidity risk, it arising from maturity mismatch between their assets and liabilities, and can provide financing for liquid for in a long-term project.
Banks. This financial institution provide both short-term and long-term financing. They usually provide a lower interest rate compared to other institutions, but borrowing money from banks usually need more requirements.
So hi guys, my name is Mark John Pulsanoy and I'm from Group 3 in Business Finance.
Oh my God! Wow!
And today, I will continue to report about the retained profits, issues equities, and debentures. So the first one is retained profits. Retained profit is amount of a business net income that is kept within its accounts rather than paid out to shareholders. Retained profit is a strong indicator of the long-term financial stability of a business. And also, retained profit brought forward is the combined retained profit from the every accounting period since a business began. For example, if a business is in its third year and had a retained profit of £5,000 in each of the first 2 years, then its retained profits brought would be £10,000. So next is issues equity. Equity issue means any issue of partnership, interest, or shares by the borrower, or any issue or grant of rights to subscribe for or to convert any security into partnership interest or shares in the borrower. Equity also is the ownership of any assets after any liabilities associated with the assets are cleared. For example, if you own a car worth $25, but you owe it $10 on that vehicle, the car represents $15 equity. It means it is the value or interest of the most junior class of investors in assets. If liabilities still exceed assets, then there is negative equity, and if it assets exceed liabilities, there is positive equity. So next is debenture. A debenture is a marketable security that businesses can issue to obtain long-term financing without needing to put up collateral or dilute their equity.